Hello friends, today we are going to talk about account reconciliations. Account reconciliations are a very important part of the finance and accounting outsourcing that happens all throughout the world. We will talk about what do we mean by account reconciliations, why do we need them, what is the purpose, and how they best help the companies so they are that much needed. Let us first see what do we mean by an account reconciliation. You might remember that in your school days or in your college days, you would have gone through something called bank reconciliation statement. So we know that a reconciliation statement would mean some document or some statement which helps us to reconcile or match the balances between two different accounts. So in case of a bank reconciliation, we used to match the bank statement given by the bank with the cash or bank account that the company used to maintain. So you are reconciling two sides of the same account based on the documents maintained by two different parties. Similarly, on a broader level, we can define an account reconciliation as providing adequately documented and supported explanation of the ending balance of a general ledger account. So, an account rec can be prepared for any account in a balance sheet, or it can be prepared for all assets and all liabilities in the balance sheet. It is done normally to provide an explanation of the ending balance. A statement is prepared to explain the various components of the ending balance. Now, what do we mean by components of the ending balance? We all know that whatever goes into the balance sheet, or rather, whatever goes into the trial balance, that is the ending balance of a certain account. The ending balance comes as a result of the opening balance plus all the transactions which happen in that account throughout the year. Now, if, for example, we assume that the opening balance is correct and is the one which should be appearing in that particular account, hence we are sure of the nature of the opening balance. Now, how do we know that the entries which have happened or occurred in that balance or in that account throughout the year, they are correct? To ensure that, you need to have them verified with independent documents. Suppose you get them verified also. Now, as part of the closing balance, you have the opening balance verified and correct, and also you have got the entries in that account verified and documented as correct. If both these components are correct, then your closing balance is also correct and represents the correct amount which should appear in that account. After going through the definition of account reconciliation, we now understand that it basically would mean that we ensure the closing balance of an account is reasonably prepared or reasonably comprised of items which have been verified by the accountant or by the auditor. Hence, an account reconciliation serves as an audit tool. It is in the nature of an audit which ensures that the ending balances of all GL accounts are stated correctly and truly, as evidenced by documentary proof, and also that all material elements of the balance are properly explained. So whatever comprises the closing balance, we have to ensure that it is correct and it has got documentary or supported proof which helps in verifying that closing balance. Now, since the balance sheet and the profit and loss are submitted to various regulatory authorities, hence it is of utmost importance that they are stated correctly. Account rec helps in ensuring the same. An account rec helps in making sure that the closing balance is correct and hence making sure that whatever documents are given to the government authorities, they are also representing the correct ending balance. The third important benefit of an account rec is that It helps not just the external stakeholders like the government or statutory bodies, etc., get a fair view of the financial statements, but it also helps the internal management to arrive at correct decisions. A correct balance helps the management in knowing the real position. If, for example, an account is not verified or it is not reconciled and it shows a balance of say 1 crore of rupees, the management will not know that whether the balance is actually 1 crore or whether it is only 10,000 or whether it is 1000 crore. The fact that the account is reconciled means that the balance is correct and it is shown in the correct account also. Let's now go through some of the points that one needs to keep in mind to prepare a correct account reconciliation statement. The first point is that you have to ensure that the correct account is used for recording the correct transactions. In case it is a purchase of plant and machinery, then only the amounts relating to plant and machinery purchase should be debited to the plant and machinery account, not anything which relates to furniture, fixtures, or building, etc. So, correct account is used for recording the correct transactions. Second point is that the items that comprise the closing balance of the account, they need to be verified as true and correct. So if the balance of plant and machinery shows value of 5 lakh rupees, then the 5 lakh rupees, whatever plant and machinery comprises that 5 lakh rupees, we are aware of that where it exists, and also that the amounts shown are correct. Third is that the sources from which the above mentioned items are verified, they need to be independent and proper. There has to be a third party kind of document like a bank statement, statement from debtor, creditor, or tax calculations, etc., which form the correct independent document on the basis of which the balance can be verified. Now, point number 4, which has to be kept in mind for doing a reconciliation, is that we need to correct any error that we find at the earliest possible. So any mistake or error which will either get automatically corrected or which needs a manual correction, it should be resolved and corrected at the earliest. The reconciler and the reviewer need to have adequate knowledge of the account rec that they are performing. Reconciliations need to be completed as per a fixed frequency or they are completed within a reasonable time period. Now this is important because if reconciliations are not performed as per a fixed frequency, there will be tendency in the reconciler to procrastinate the reconciliation, and which can ultimately lead to errors which still remain hidden. Another important point to be kept in mind is that the reconciliation period frequency and the kind of proofs accepted for the closing balances, they need to be listed clearly in the accounting policy document. Hence there should be standardization so that any person who performs the reconciliation performs it as per the given accounting policy without any kind of subjectivity creeping in. Hence, whether A reviews the reconciliation or whether B prepares and reviews, the reconciliation will be as per the accounting policies which the company has put in place. Point 8 for the same is that the reconciliation frequency and depth of analysis, it also depends on the type of account. Hence, if we are reconciling an account which is riskier, say for example cash, bank, etc., wherein the balance should be correct even on a daily basis, the frequency for reconciliation should be higher and the depth of analysis should also be much deeper. With respect to accounts like building, plant and machinery, furniture, fixture, etc., wherein changes happen once in a while, we can have a quarterly frequency also. But normally speaking, cash, bank, etc., should be reconciled on a daily basis, and the other accounts can be preferably reconciled on a monthly basis, but at the least need to be reconciled on a quarterly basis. Let's now talk about some other definitions for account reconciliation. Here, any item which is recorded in the books properly and which has got adequate documentary proof, we call it a recorded item. So we did not do anything regarding a recorded item because it has been correctly recorded and there is adequate proof also supporting the same. In case an item has got adequate documentary proof but for some reason has not got properly recorded and therefore needs a correction, we call that item an open item. It is open because there is some action which has to be taken with respect to that item to ensure its correctness. An unreconciled balance is an account in which we do not know why the balance exists. So there it has got an item which is neither properly recorded nor does it have any proper documentary proof. For such unreconciled balances, we really need to dig deeper to find out how the balance has been arrived at, and to whatever possible extent we should try to reconcile that, and if there is still some amount which cannot be reconciled, then the company will need to show it in the profit and loss account either on the debit or the credit side depending on the kind of balance it is. Now account reconciliations can be prepared in different formats. They For most of the companies they have got either an account reconciliation template or an ART which can be either proprietary for the company or that can be something which is purchased from uh, an accounting firm providing such reconciliation formats. Some other companies prepare account reconciliation in Excel sheets also. Given below or on your slide is a format for account reconciliation for a cash account. Now some of the important features of a reconciliation need to be reflected in this template also. So there is a date on which the account is reconciled. There is the account name which is properly reflected as cash account. An account number is given to the account as per the chart of accounts. So every company will have a chart of accounts which bifurcates the various accounts that it uses into different categories. So broadly they can be assets, liabilities or equity accounts and income and expenses. And further if you drill down they can be cash accounts or bank accounts in bank A, B, C, etc. Plant and machinery which is located at plant in India, plant in Sri Lanka, etc. Next thing is we start off with the closing balance as per the GL. We see this is one side of the account that we are trying to reconcile. So as per the GL, the balance of cash or bank with the company is 1 lakh INR. As per the bank account, the balance is 90,000. So the difference is 10,000. We see that the balance of 1 lakh rupees is not getting substantiated properly and adequately as per the balance in the bank account, and there is a difference of 10,000. Now we need to find out what is the reason for this 10,000. On getting more details from the bank, we noticed that a check was issued but which was not yet presented of rupees 11,000. Similarly, bank had charges in the bank statement which were still not reflected in the cash book amounting to rupees 1,000. A net of these two items amounts to rupees 10,000, which is the difference between the bank account and the cash account. Hence, the total of open items amounts to 10,000. Some of these open items get corrected automatically, whereas for some we need to pass an adjustment. We are already aware of timing differences. So timing difference of 11,000 rupees, which is a check issued but not yet presented, should get automatically reconciled. For the other amount of rupees 1,000 shown as bank charges, we need to make a correction in the cash book. Hence the account status will be reconciled because we know what are the open items and what is the action that has to be taken on them. The account rec also needs to have a signature of the person who prepares that and the signatures of the person who reviews the account reconciliation. Now as regards the open item of 1,000 rupees which are bank charges still not shown in the cash book, we need to assign a person who will make the correction. We need to have a timeline by which the correction will be made. and preferably have a journal entry which will be passed at that particular time. There can be different variations of the account reconciliation format, but more or less these are the important items that each and every account reconciliation template must show.